If you're in business, finance, really any part of the economy, you have to speak the language of financial accounting.
You really do. It's the invisible framework for everything.
Right. But for most of us, opening a company's financial report, a 10K or something, it feels like trying to read a completely foreign language.
It can be intimidating, for sure,
Mhm.
but, it doesn't have to be. These documents are really just the story of a company, its health, its performance.
And if you can decode that story, you get this incredibly powerful insight into, well, everything.
Market dynamics, how a company is valued, all the pressures it's under.
And that's exactly our mission today. We've dug into some foundational accounting texts, our sources for this, to pull out the absolute core concepts.
The key players and some really powerful forces that are reshaping the rules of finance as we speak.
Okay, so before we dive in, there's one quick clarification our sources make right at the top,
Yes. The difference between bookkeeping and accounting.
which people often use interchangeably, but they're not the same.
Not at all. Bookkeeping is just the raw data collection, the systematic record of transactions.
It's the diary.
It's the diary, exactly. Accounting is what you do with the diary. It takes all that raw data and organizes it into summary reports
And those reports are for what?
for evaluation, for making informed decisions about the future. It's analysis, not just, storing records.
Okay, let's unpack this a bit more. The first major distinction is financial accounting versus managerial accounting. We're focused on financial, right?
Right. Financial accounting is for the outsiders, the external users, anyone outside the company who needs to evaluate it.
And managerial accounting is for the insiders.
Exactly. For managers to control costs, make budgets, that kind of thing. So today, it's all about what a company shows to the world.
So we'll hit the three main reports everyone sees. Then we'll look at the surprisingly long list of people who actually use them.
And then the rule makers. And finally, the huge technological and global forces that are changing the whole game right now.
Okay, let's jump straight to the output. The whole system of financial accounting produces three primary statements.
These are the pillars. And you absolutely have to read them together to get the full story.
What's the first one?
The first is the balance sheet. I like to think of it as the company's big inventory check.
So what's on it? What's it counting?
It reports a company's assets, what it owns, its liabilities, what it owes, and the owner's equity.
And here's the crucial part, right? It's for one single specific point in time.
Precisely. It's a snapshot. Like, here's where we stood financially on December 31st. Not over a period, but on that one day.
Got it. The snapshot. So the second pillar must be the one that tells us how the business did over time.
Yes, that's the income statement. And this is where we hit maybe the most important concept in all of financial accounting.
Which is?
Accrual accounting.
Okay, define that for us, because it's not intuitive.
No, it's not. The income statement is not about cash in, cash out.
Yeah.
It's built on this accrual idea. It records revenues when they are earned.
Not when the cash arrives.
Exactly. And it records expenses when they are incurred, regardless of when the cash is actually paid.
So it's trying to capture the economic reality of a transaction, not just the movement of money.
That's the perfect way to put it. It's matching the revenues to the costs that, help generate them,
And the bottom line of that statement is net income.
which is just the difference. Revenues minus all those corresponding expenses. It's the metric for profitability.
Okay, but that creates a problem, doesn't it? If the income statement isn't tracking actual cash, a company could look profitable but actually be running out of money.
And that brings us to the third pillar, the one that solves that exact problem, the statement of cash flows.
This one is pretty self-explanatory, I guess.
It is, but its structure is key. It tracks the real cash coming in and going out, and it breaks those movements into three very specific categories.
Let's quickly go through those because they tell you a lot.
Okay, first is operating activities. This is cash from the core business. Selling your products, paying salaries, that sort of thing. It shows the health of your day-to-day.
And the second.
Investing activities. This tracks cash used for long-term assets. So buying or selling property, new factories, big equipment.
And finally, financing activities.
This is all about how the company interacts with its owners and lenders, issuing stock, paying dividends, taking out a loan, or paying one back.
So by separating them, you can see exactly where the cash is coming from and where it's going. Is the business itself generating cash, or are you just borrowing a lot?
That's the question it answers. And when you put those three statements together, you get the complete interconnected picture.
Here's where it gets really interesting, at least for me. We have these reports. Who actually reads them? Who cares?
And the sources are really clear on this. The list of users is extremely broad. It goes way beyond just the obvious ones.
So the pressure on companies is huge because this one set of documents has to serve all these different, sometimes competing interests.
Right. Everyone is looking for something different.
Let's start with the most obvious group, lenders and investors.
For them, it is almost purely about the future. They're trying to evaluate future cash flow.
A lender wants to know if they'll get their money back.
And an investor wants to know if the company is going to be profitable enough to give them a good return. It's all predictive.
Okay, but then the list gets wider. It goes into the supply chain, right?
Oh, absolutely. Think about suppliers, customers, even employees. They're all using these statements to judge the company's long-term stability.
If you're a supplier, you want to know if you should extend them credit.
Exactly. Are they going to be around in 6 months to pay that bill?
Yeah.
And employees, they're checking for solvency before they stake their career on a company.
What about competitors? I imagine they're digging through these reports.
For sure. They are looking for strategic weaknesses. Maybe they see R&D spending is down or that a certain division is struggling. It can reveal a lot about strategy and opportunity.
Now, this next one is fascinating. Government agencies and politicians.
This is a really critical point in the source material. These groups use the data to bolster their positions.
What do you mean by that?
Well, they might use a company's profit numbers to argue for a new industry regulation, or maybe lobby against a tax change that could hurt the company. The data becomes evidence in a political debate.
That is remarkable. The very same number that a CEO uses for a bonus calculation could be used in Washington to argue for a new law?
It happens all the time. And finally, of course, you have the press. They use the data for background to spot trends and tell the public which companies are making big moves.
It's just amusing that one standardized system has to serve all those masters.
And that complexity, that need for everyone to trust the numbers, is why we need rules.
Strict rules. The sources say that without them, comparing companies would be, and I'm quoting here, extremely difficult and costly.
It would be chaos.
So who sets the rules? This is where we get into that alphabet soup of regulatory bodies.
In the United States, the main standard setter is the FASB, the Financial Accounting Standards Board.
And they create what we call GAAP, right?
Yeah.
Generally accepted accounting principles.
Oh, right.
But here's the thing that really surprised me. The FASB is not a government agency.
No, it's a private body. It's supported by the business community, accountants, analysts.
Wait a second. If it's a private group with no legal power to enforce its own rules, why does anyone listen to them? How does that work?
That's the core of it. Their power comes from their prestige. The market trusts them because they've built this incredible reputation for being independent and rigorous. Their influence is their reputation.
So they have to protect that reputation at all costs.
At all costs, because it's all they have. Now, public companies are required by the government to follow their standards, but the standard itself is set privately.
Okay, so if FASB sets the rules, who is the government enforcer?
That would be the SEC, the Securities and Exchange Commission.
And their job is to
Regulate the U.S. stock exchanges. Their main goal is to make sure there's a fair information environment so investors don't have to worry about fraud or manipulation.
So they're the police of the financial markets.
A good way to think of it. And then there's another layer. Who checks the auditors? The people actually verifying the statements.
Right. Who audits the auditors?
That's the PCAOB, the Public Company Accounting Oversight Board. They can inspect audit firms, impose sanctions. They can even ban a firm from auditing public companies.
So they're the federal watchdog over the whole audit industry.
Exactly.
Okay, we have to pause here because this confuses everyone. Where does the IRS fit in? Taxation.
It is so important to get this straight. The IRS has absolutely no role in setting financial accounting rules for external reporting.
None.
Zero. The IRS sets tax rules to define taxable income. The financial statements we've been talking about are not used to calculate a company's tax bill. They are two completely separate systems.
That's a critical distinction. And it highlights the global challenge because U.S. GAAP, set by the FASB, is just one system.
And that's where you get the IASB, the International Accounting Standards Board.
And their goal is one set of rules for the whole world.
A common set of global standards, yeah. They're called IFRS. And they're being adopted more and more, which is creating this huge, complex push and pull with the FASB here in the U.S.
Let's bring this into the present day. Our sources identify three massive factors that are combining right now to create, quote, significant change in accounting.
This is not a static field at all. The ground is literally shifting.
Okay, what's factor one?
Technology, just the raw power of information technology today.
Meaning we can process so much more data than we ever could before?
Exactly. Users can process gigabytes of information, and that raises this really important policy question today. How much information should companies be required to share?
It's not a technical question anymore, it's a policy question.
Right, it's about mandated transparency.
Factor two is that international integration you just mentioned.
Yes, investors are demanding consistency. If you're running a global fund, you want to be able to compare a German company and an American company side by side,
Using the same rule book.
using the same rule book. So these diverse national practices are being forced to harmonize. That push for one global standard is happening as we speak. It's historic.
And the third factor. This one feels a bit more reactive.
It's all about scrutiny. This is the direct result of the huge corporate accounting scandals around 2001. Enron, WorldCom.
This completely shattered public trust,
They did. And that led directly to the Sarbanes-Oxley Act in the U.S.
which was a massive increase in government oversight.
A dramatic increase. It imposed much stricter controls on how financial statements are produced, how executives have to personally sign off on them. It was a total overhaul.
So what does this all mean when you put it together?
It means accounting is being redefined from three sides at once. By the flood of data from technology, the geopolitical pressure for one global standard, and this intense government demand for integrity.
So to wrap this all up, if you take one thing away from this deep dive, it should be that financial accounting is a system for decision-making.
High-stakes decision-making. It's so much more than just recording numbers. It's built on that core principle of accrual.
And it serves this incredibly wide, often conflicting array of powerful users. We're talking everyone from investors and competitors.
All the way to politicians and journalists.
And the rules themselves are set by this really complex balance. You have the private prestige of the FASB on one hand,
And the federal power of the SEC and the mandates from Sarbanes-Oxley on the other.
the tension we see today between the U.S. system and the global IASB system, it really just highlights how hard it is to create universal trust.
Especially when different countries have such different histories with regulation and business practices.
And if we really connect this to the big picture, the challenge right now is managing that balance.
You have the push for massive data transparency, which technology makes possible, against the absolute need for integrity and trust that came out of the post-scandal era.
Which leads us to a final provocative thought for you to consider.
We know from the sources that these financial statements are explicitly used by politicians and government agencies to bolster specific political and regulatory positions.
So think about this. The ongoing debate about standardizing disclosure, how much a company is legally required to share with the public, is it really a technical accounting debate?
Or is it fundamentally a political conversation about corporate power, transparency, and trust?
That power dynamic makes following these regulatory bodies, the FASB, the SEC, well worth your time. That was our deep dive into financial accounting.